I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. And as we come around this time of year, all Americans have to face the April 15th deadline for we all know what for. So with that said, that's our topic today. And
yeah,
hello, Jeff.
Yeah, it's tax time. It's one of the great privileges of being in this country, Steve, and that is that you get to pay taxes. So we'll dig into that a little bit deeper here today. We'll talk about the different taxes in our system and how you can maybe plan to pay a little bit less taxes. So it's going to be a good show.
Good.
Yeah.
So why don't we start off with maybe going back in the history of taxes and why and some dates.
Yeah. So the history of taxes in this country, and of course it goes all the way back to the Civil War back in 1861, where they levied a tax because they had to pay for the war, right? So, and of course it's evolved. Our tax system has evolved significantly. We look at if you just look in more recent history, like say the last 100 years. We've had tax law changes like on average, like once every 3 years, major changes. So, and it's constantly evolving and changing. And of course, every time it changes, Steve, it gets more complicated. It gets more complex, and it keeps our accountants and our CPAs busy because they're the ones that have to interpret these tax laws for the common person.
I think the government really got its hands around it with the 16th Amendment.
Yeah, yeah. I mean, when you think about it, it is an efficient way for us to pay for our government. And of course, the cynics say, talk about the politicians and how they spend money and that kind of thing. But you need some kind of system for everybody to pay their fair share. And of course, there's always great debate as to what is fair. But I think it's important to note that we do have a great system, but it's complex. And a lot of people try to do their tax return on their own. They've got all these automated systems now, these computer-based systems where you can go in and file your own return. But if you've got any kind of complexity in your financial world, sometimes it's best just to hire somebody that knows what they're doing to file your return.
And when we look at tax brackets on the federal side, let's give that a little whirl.
Well, the federal taxes, actually, they've changed quite a bit right now. So we have a chart that shows you the different tax brackets, and we have what's called a graduated system. So you're on the first dollars that you make, you don't pay any tax, and then it goes up to 10%, and the next level it goes up to 12, and so on and so forth, all the way up to a top rate right now of 37%. So if you look at that, Steve, and you compare that historically, like let's say you look at maybe tax rates maybe 50 years ago, it's the highest tax rate was a lot higher than it is now. You had tax rates upwards of like 90%, right? So you were paying a lot higher tax. And of course, the structure was different. There was a lot more loopholes and a lot more ways to get deductions and write-offs and things of that nature. But the taxes themselves were a lot higher than they are now. And sometimes people say, well, geez, we pay a lot of money in taxes. But comparatively speaking, we really don't. When you compare it to the way our system used to be, the tax rates are actually much lower. And also, when you compare it to some other countries, free countries,
Sure.
We're paying a lot less, right? So, this is sort of a plug for America and our system, but not that it's perfect by any means.
Sure.
Don't get me wrong, and I don't want any of our viewers to misunderstand that. We do have our share of issues and problems, and we're not going to get into any kind of political discussion, Steve. But we do have a pretty good system.
And a lot of times we talked about, on average, three-ish years for a tax law change. We're coming upon one here with it sunsets in 2025. What's a sunset?
Well, the sunset they call it sunset because every day the sun goes down, it's called a sunset. Well, they came out with this tax legislation, and I forget what year it was, 2018. That sound right?
1819, maybe.
It was like a few years back.
Yep.
They came out with this great big tax law change, and they changed everything. They changed the rates and the deductions and all that stuff. And it's funny. It was supposed to make it easier because they were eliminating they jacked up the standard deduction.
I remember one commercial where one of the politicians had the little 3x5 card.
Yeah.
It's really going to make it simple.
Yeah, and of course it didn't. But anyway, so the sunset part of that is that when they legislated that piece of taxes, they said that it was going to end in the year 2025. Was it 25 or 26?
One of the two.
Yeah.
One of the two.
Sunset legislation. So they were going to get. So that means that if they don't change it between now and then, that it reverts back to what it was. So we're actually coming upon that.
And normally what happens there is they actually make some of that permanent, and it doesn't sunset, and some they just let fall off. Let's talk a little bit about, because we talked about income, what about capital gains? Maybe the history of capital gains, where are we now?
Yeah, so capital gains is, another kind of a sticky subject because so first of all, there's short-term capital gains and there's long-term capital gains. So a long-term capital gain is defined as any asset that's been held over 1 year. Then you sell it, it becomes a long-term capital gain. So the tax rates on capital gains are different than taxes on ordinary income. So taxes on capital gains can be anywhere from 0 to like 15%. It's a much lower rate than, or like I said, ordinary income. So it's really designed to place a tax on appreciated property. So let's say that, look, I'll give a couple examples. So let's say that you buy a piece of land, you buy a house, and it's worth $200,000 when you buy it. You'll hold it for a couple of years, and then you can turn around and sell it for $300,000. So there's a $100,000 gain there, and that's a capital gain. Okay, now, again, things are complicated in our system. So if it's your primary residence, and you're now selling that and you're buying another primary residence, then it doesn't count, right? You're just simply, replacing one house for another house. If it's an investment property and you're taking the sale of the one piece of land, piece of property, and you're buying another piece of property to improve, you're just rolling it over, so to speak. That's considered a 1031 exchange. That's not taxable either. But let's just say you're selling it for cash. You're just selling it pure and simple with cash. That's a capital gain. So that $100,000 gain you would report as taxable income, capital gains tax, I should say. And depending on where your tax bracket is, you're probably going to pay 15% tax on that capital gain. Now, one disclosure that I think we should make here is that it's important that you consult a tax professional when you're contemplating any transaction that has tax ramifications, right? So neither you or I are tax professionals, right? So we consult tax professionals in our world, and we advise our clients to do the same thing. So we're trying to just facilitate that and have a basic understanding of the way taxes work here in our country, but you want to have the advice of a professional. Unless you have a super easy return and you can plug it into a computer and spit out a simple tax return.
Probably using the standard deduction.
Yeah.
Yep.
Yeah. Other than that, you're probably better off spending the money to have a professional do it and do it right, and really keep you from, getting an IRS audit.
And you talked about long-term capital gains and short-term capital gains, but as Americans, we have pre-tax investments such as 401ks and IRAs.
Yeah. Yeah.
Tell us a little bit about those.
Yeah. Well, the significance of that is that, most of the wealth that was built here in Middle America was really done through payroll deduction. Like if you look at the baby boomers that are now millionaires, most of the millionaires have become that through their employer, through the 401k. So what that means is that they're sitting on a lot of money that is tax deferred. So that money is going to eventually be taxed to somebody. It's either going to be taxed to the worker during their lifetime, and I'll get into that in a minute, or it'll be taxed to their spouse when they die, or it'll be taxed to their children when both spouses die. So what I mentioned a little bit earlier is that you're going to be taxed during your lifetime, and that is on any retirement account, whether it's a 401k or an IRA. When you reach the age of 73, you have to take a required minimum distribution, or what we commonly referred to as an RMD. When you have to take an RMD, that means you have to pull money out of your retirement account and pay the taxes on it. So in other words, what our government is saying, what the IRS is saying, is that you can only defer taxes for so long. Once you reach the age of 73, and then every year thereafter, you have to take a distribution from your account, and it's based on a table. It's based on your account balance and your age, your life expectancy, and you have to pull money out and you have to pay taxes on it. That's just the way, that's the way the system works. You pay taxes, and then eventually the account gets emptied out, and the IRS gets their taxes, and everybody's happy.
When the RMD age was 70 and a half, you used to be able to stretch an IRA, and then with the change, they've changed the environment on that.
Yeah, so when you mentioned 70 and a half, so back in 2019, there was legislation. It was called the Secure Act. And what the Secure Act did was it changed two significant things. It changed the RMD age from 70 and a half to 72, which is now 73. They changed it one more time.
Yep.
But they changed it to 72. The other thing that was part of that legislation was that in exchange for the RMD age being pushed out to age 72, they eliminated the stretch IRA. What the stretch IRA did previously was it allowed a non-spouse inheriting an IRA. So let's say your children, right? Your children inheriting an IRA. They could stretch, and we use this term a lot, a stretch IRA. They would stretch the IRA out over their lifetime, right? So Steve, you have 3 children. So let's say today's the day, right? You're not here anymore, your wife's not here anymore, and your 3 children inherit your vast fortune. And this vast fortune is in retirement accounts. So you have three kids. The account gets cut up into 3 pieces. They each get a third, and they could previously stretch out the IRA over their lifetime, right? So you have a 17-year-old son who could stretch the IRA out over his lifetime. So if you look at a life expectancy table, he's probably got a good 70 years left.
Yep.
To his life. Maybe not 70, but it's somewhere around there. Yep. So that's pretty powerful that he could stretch that out. So, but no more, right? So just erase all that, and now those retirement accounts have to be emptied out within 10 years. So that really has changed the game in terms of the planning that we do.
Yep. In the estate planning, if someone's married, there's a spousal IRA.
Spouses are different. So when you're inherit an IRA from a spouse, it's as if the IRA were your own. So husband and wife, there's a husband and wife, the husband dies, the wife inherits the IRA, and it's if the IRA were her own. So particularly, like if the wife is younger or if the spouse is younger, you can now make that IRA your own. So I'll just use myself as an example because my wife is 5 years younger than I am. So if I died and my wife got the IRA, my IRA, which she will, she would put the IRA in her name, and then that would postpone the RMD another 5 years. So it wouldn't be until she turned 73 that she would have to take an RMD. So depending on the situation, it makes sense to take advantage of putting the IRA in the name of the spouse.
And when we talked about
upon death.
When we talk about traditional IRAs and RMDs, what's the advantage of a Roth IRA around taxation?
Well, quite simply, the advantage of a Roth IRA is tax-free growth. It's one of the few things in our tax system where you can get tax-free growth, right? So, and now they've got the Roth IRA inside of a 401k. So it's technically called a Roth 401k. And I always tell my kids this, take advantage of the Roth 401k because you're getting tax-free growth for the rest of your life, right? And then of course you can name your children as beneficiaries, so then that gets passed on to them for another 10 years after that. So that is the main benefit of a Roth IRA versus a traditional IRA. And maybe your next question, I don't know. I don't see your questions there, Steve, but let's say your next question is, well, what about a Roth conversion? So with a Roth conversion, you're converting the traditional IRA into a Roth IRA, and you're paying the tax when you do that. So you're reaching into the future and taking all the future tax liability that you would have with a traditional IRA, and you're paying it this year.
Yep.
You're paying it currently. And then so then you don't have to pay any more taxes on that account, on the Roth IRA. You're free and clear. You're tax-free. So it's a very common planning technique that we use, and a question that I always ask our clients is, are you ever going to spend this money? And if the answer is no, it's what we call leave on money. Leave on, I'm going to leave it on to my family, to my beneficiaries. Well, if that's the case, then you can make an argument that you should convert the traditional IRA into a Roth IRA, pay the tax, you have all this tax-free growth. Now, there's some perils to that, and one of them is that you have to find the money to pay the tax.
Yes.
Right? So, it may accelerate you up into a higher tax bracket. So if we look back at one of your earlier charts there, Steve, you see we've got that graduated tax system. So let's say you jump up from I'm looking at your sheet there, you jump up from a 24 to a 32% tax bracket. So it may cost you 32% in taxes. So that's the big game changer right there. That's why a lot of people don't do it, because they don't want to pay the tax. Number one, they don't want to pay the tax, and number two, sometimes they don't have the money to pay the tax, and it generally doesn't make sense to cash in or redeem a IRA account, a traditional IRA account, simply to pay the taxes, right? So let's say you're doing a $50,000 conversion. You're converting $50,000 of traditional money to Roth money. And you got to pay taxes on $50,000. Well, if it throws you up into the 32% tax bracket, then that's going to cost you what? $16,000.
Sure.
So now instead of taking out $50,000, you got to take out another 16. So you got to take out whatever that math is, $66,000
Sure.
to get a $50,000 Roth.
Yep.
That generally does not make sense.
Yes.
Generally does not make sense. But if you have cash in the bank, right, which we have found with a lot of our clients, they do. They got money in the bank. So if you got $16,000 in the bank, that's just kind of sitting there, and you're saving it for a rainy day, and you're making maybe a little bit of interest, not much. You can make an argument that you should just take that $16,000 out of there and use that to pay the tax on the $50,000 Roth that you just converted. And guess what? Now the $50,000 is going to grow tax-free for the rest of your life, and really the rest of joint life, right? So again, Steve, I'll use you're my example here today. So you don't mind if I share your age, do you?
That's
okay.
fine.
All right. So Steve,
50, 50 's
so
okay.
Steve is 60 years old, and I don't know how old your wife is, but let's just say she's the same age. Okay, so your wife is the same age, she's 60 years old, and you've just converted your Roth IRA. Now you have tax-free growth over both your lifetimes, right? So let's not even get into your health, and I know you're a healthy guy, but let's say we don't even know that. Let's just say you're standard health, your wife is standard health, and so the life expectancy, the joint life expectancy of a 60-year-old couple is probably somewhere in the neighborhood of, let's say 27 years. Let's say 30 years. Let's give you 30 years. We're going to give you the benefit of the doubt because you're a little on the healthier side. I know, I see what you eat. You watch what you eat, and you really take good care of yourself. Athlete and everything else. So you're going to live 30 years. Well, you got 30 years of tax-free growth on that Roth account. So you felt the pain this year. It was a little painful to do that, wasn't it? Because you had to put that on your tax return as an IRA distribution. Right? So you had to write that check, and it hurt a little bit. Maybe it hurt a lot to do that conversion, but now guess what? You got that Roth growth. So you got 30 years of growth. Let's say just theoretically, you have 30 years. You might not have 30. I mean, if you and your wife die in a disaster next week, you got a week. So that's the risk. That's always the risk that you take, and everybody understands the risk. But it might not be 30 years. It might be 40.
Sure.
You might live longer. The point is that now we're going to sit down with you, Steve, and I'm going to say, look, Steve, we got a long time horizon here. We got a really, really long ramp here, 30 years. So we should really look at your risk profile and say, we're going to go long on this one. We're going to go really, really long because it's money you're not going to spend. It's going to go to your 3 children. You're going to go long. We just want the optimum growth. So we're going to take a lot more risk with that part of your portfolio than we are with the rest of your portfolio. Because the rest of your portfolio, we've got to deal with other issues. We've got to deal with income. We've got to deal with emergencies, liquidity, all that other stuff. But with this Roth account, with this Roth piece, we know with reasonable certainty that account is going to grow tax-free for the next 30 years. So if we have 30 years, and we know there's going to be ups and downs, but we also know historically, if you're in equities, that's where you're going to get the most growth over time.
Sure.
Tax-free growth.
Tax-free growth. Makes sense.
How about it?
I like it. Makes sense.
Yeah.
Now, if we go more, we're done with the federal. Let's go to the state of Pennsylvania and different states. What's that look like?
Well, each state has their own tax system. Here in the wonderful state of Pennsylvania, we have income tax at a rate of 3.07%. So it's a flat tax. It's fairly simple to do, the Pennsylvania return. All your income in here in the state of Pennsylvania is taxed at 3.07%. Now, if you go, I don't know the tax rates of other states, but I know, like in the state of New Jersey, which is a neighboring state, obviously, their tax rate is a little bit higher. And I know that because my son used to live in New Jersey, and he would tell me, he would complain about paying New Jersey state income taxes, and I said, well, why don't you move back to Pennsylvania? So that's what he did. But anyway, and every state's different.
Sure.
So it's a little tricky in that you got to watch where you live and where you work. So here in Pennsylvania, 3.07.
And then we get down even to a more smaller level, local taxes.
Yeah, local taxes. Yeah. So again, each local municipality levies an income tax. So like here where I live, it's 1%, right? So 1% of my income I've got to pay in local tax. Now you got to be a little careful. So if you live in the city of Philadelphia, it's higher. It's a lot higher. It's 3.4. What did I say it was? 3.45%.
Over 3, yeah.
So, and that rate changes because I remember it used to be higher than that. But
Sure.
you know, because I remember I was talking to one of my other sons who wanted to move to Philadelphia, and I said, well, you know, if you move to Philadelphia, you're going to pay a city wage tax. You're going to pay 3.45%. Oh, I didn't know that, he said. He's used to paying 1%. So I said, yeah, it's like getting a pay cut. Because he'd be doing the same job, he's working from home. So,
Yep.
you know, if you're working from home and the tax rate's 1% and you move, it's, you know, 3.45. So that's that one.
Yep. And if we move to self-employed people, or not even self-employed, but what about Social Security taxes?
Well, if you're self-employed, right, this is real simple. If you're self-employed, you're paying both ends of Social Security tax. You're paying your piece of it and you're paying the employer piece. So just bear in mind with Social Security tax, when you see it coming out of your paycheck, your employer is also paying that same amount, right? So if you're self-employed, you're paying both sides of that. So, and I don't know what the Social Security rate is, but it's over 7.5%. So let's say, you know, the employer's paying upwards of 15% or more in taxes. So I see we're coming to the end of another exciting show here, Steve. Well, gee, this was really good. I mean, we didn't really get into some of the stuff we wanted to talk about today with all the wonderful things that are going on here in our company, but we can save that for another day. It was important to talk about taxes since it's April 15th and it's tax season. So we'll put this show out on YouTube, and you'll be able to see it locally here on the PCTV network. It'll be on our YouTube channel. It'll be on our website. And with all that being said, we're going to sign off here. This is Financially Speaking.